Most people think the danger begins when the law changes. That is not when the danger begins. The danger begins much earlier, in the long, quiet stretch, when ordinary people stop paying attention because they assume the system is only aimed at somebody else. I want you to picture a retiree who has done almost everything right. She is not hiding money. She is not running some shady side business. She is not laundering cash, evading taxes, or moving funds around in the shadows. She is living on Social Security, maybe a pension, maybe a required minimum distribution from an IRA. She spent 40 years building one paycheck at a time. Her money moves in plain sight. It moves the same way every month. A deposit comes in, a bill gets paid, a prescription gets filled, a grandchild gets a birthday gift, a furnace breaks in January, a dentist bill lands in April. Nothing about her life looks criminal. Nothing about her behavior looks exotic. And yet she can still find herself feeling nervous when she hears one phrase, bank reporting. That phrase bothers people because it touches something deeper than taxes. It touches the feeling that your private life can be pulled into a system you do not fully understand, judged by thresholds you did not set, interpreted by people you will never meet, and defended only if you have the records, the patience, and the stamina to explain yourself after the fact. I have spent my life studying capital, incentives, institutions, and the way human beings behave when rules meet fear. And one thing I have learned is that the average person usually does not get hurt by the rule they know. They get hurt by the rule they never bothered to understand because they assumed it was meant for somebody richer, shadier, or louder than they are. That is why this conversation matters. Not because you need panic, not because you should start acting like the government is about to knock on your door tomorrow morning, but because if you have a bank account, if you deposit cash from time to time, if you are retired on a fixed income, helping family, taking distributions, or simply trying to keep your financial life simple, then this is exactly the kind of issue that can catch you flat-footed if you treat it like background noise. Most people hear the phrase $10,000 rule and think they understand it. They usually do not. They think it means the government watches every dollar. It does not. Or they think it means only criminals need to care. That is not true either. Or they think some dramatic brand new law already passed and quietly changed everything overnight. That is not true based on the source material in front of us. The truth is more ordinary than the rumors and more important than the headlines. There is an old rule. There are newer proposals. There is a difference between cash reporting and broad account reporting, and the distance between those two things is exactly where most of the confusion lives. Let me start where the calm understanding has to start, under the long-standing framework that has existed for decades. Banks report certain large cash transactions. Cash is the key word there. Not every transfer, not every deposit of any kind, not your monthly Social Security arriving electronically, not a pension posting to your account in the ordinary course. The old threshold people keep referring to is tied to cash transactions of $10,000 or more. When that happens, a report is filed in the background. You do not usually receive a dramatic notice. You do not sign a confession. The world does not stop. The system simply records that the transaction occurred. The original purpose of that rule was not to hassle retirees. It was to help authorities identify money laundering, organized crime, drug trafficking, and other large-scale illicit cash movement. Whether one thinks the state always uses its powers well is a separate discussion. But the purpose of the rule, as designed, was not to follow ordinary people buying groceries and paying utility bills. So far, many people nod. They say, fine. That sounds reasonable enough. Then the conversation takes a turn, because once a threshold exists, human beings start reacting to the threshold. Some try to avoid it, some fear it, some misunderstand it. And that is where another word enters the room: structuring. That word matters far more than most people realize. If someone intentionally breaks a larger cash transaction into smaller ones in order to avoid the reporting threshold, that pattern itself can become a problem. Now think about how strange that sounds to an ordinary person. You can have legitimate money, you can owe no hidden tax, you can be doing nothing criminal in substance. But if your behavior looks like deliberate avoidance of a reporting rule, the pattern can attract attention even when the underlying funds are clean. That is where the subject stops feeling like an abstract compliance rule and starts feeling personal. Because the ordinary citizen does not live in legal language. The ordinary citizen lives in practical language. I have some cash. I do not want trouble. Maybe I should just deposit it in smaller pieces. And right there, a perfectly average person can stumble into the very behavior that causes suspicion. Not because the person is wicked, because the person is uninformed. That is the pattern I want you to notice through this whole issue. The biggest risk is often not bad intent. It is good intent mixed with weak understanding. That combination has cost people more money and more peace of mind than most crimes ever will. Now let us move to the second layer, because this is where the discussion widened and why so many people, especially seniors, began paying closer attention. The old rule is about large cash transactions. The newer policy debate was about something broader. Much broader, the proposal that caused so much controversy was not merely about one big envelope of cash walking into a bank. It was about giving the IRS more visibility into account activity above certain thresholds over the course of a year. That difference is enormous. A single cash report is one thing. A framework that captures annual inflows and outflows at a much lower level is something else entirely. And when people first heard about a proposal that would have swept in account activity above a very low number, they reacted the way free citizens usually react when they sense the walls moving inward. They pushed back. Banks pushed back. Privacy advocates pushed back. Ordinary savers pushed back. Because once you move from a system aimed at suspiciously large cash behavior into a system that potentially sweeps up millions of ordinary accounts just because money moved through them over the year, you are no longer just talking about crime prevention. You are talking about surveillance by scale, and scale changes everything. A low threshold sounds tiny to a policymaker staring at a tax gap on a spreadsheet. It feels enormous to a widow who paid taxes all her life, lives modestly, and does not want one more federal system quietly categorizing her routine financial life. That is the emotional center of this whole issue. Not fear of guilt, fear of exposure without necessity. The government, of course, has its own case. The tax gap is real. When large sums of lawful tax revenue go uncollected year after year, every politician with a budget problem eventually starts looking for better visibility. That is predictable. You do not need ideology to understand it. If an institution believes billions are slipping through cracks, it will try to narrow the cracks. That is what institutions do. But once institutions begin reaching for better tools, the burden falls on citizens to ask the only question that matters in a free society. How much power is enough to enforce the law, and how much power is too much for ordinary people who have done nothing wrong? That line is not always easy to draw, but it is a line worth drawing. Now, why are seniors paying particular attention to this issue? Because retirement money often looks simple on paper and visible in practice. A retired person might receive a monthly Social Security deposit. A pension might arrive on a schedule. Quarterly IRA distributions might hit the account like clockwork. There's nothing chaotic about it. There's nothing hidden about it. But add those streams up over a year, and suddenly the totals are no longer small in annual terms, even though each transaction is plain, lawful, and unsurprising. That is the trap hidden in statistical thinking to a retiree. These are ordinary life flows. To a data system, they are account inflows. That distinction matters. When a person hears that an account could become reportable, not because of one suspicious act, but because the total amount moving through it across a year exceeds a certain number, the person does not hear technical nuance. The person hears this: my normal life is now data, and that discomfort is not foolish. It is rational. Privacy is not just about hiding wrongdoing. Privacy is about preserving the dignity of ordinary lawful life. I have never believed you build a sound society by treating all citizens as suspects first and taxpayers second. That does not mean rules should disappear. It means rules should be narrowly aimed, clearly explained, and carefully justified, especially when they touch people who are older, less nimble with bureaucracy, and more vulnerable to clerical error, procedural confusion, or simple exhaustion. This is where the conversation becomes practical instead of political. Suppose you are 74. You live on fixed income. You are not wealthy enough to keep a family office on retainer. You are not reading Treasury memoranda for recreation. You have one or two accounts. You are trying to handle required minimum distributions, medical bills, property taxes, insurance, and maybe some help for a child or grandchild who has fallen on hard times. You hear about expanded reporting and you do not immediately ask, is this constitutional in theory? You ask something simpler. If my account is flagged for any reason, do I have the strength to deal with it? That is the question older Americans ask, because older Americans understand one thing better than young ideologues ever do. Even when you are right, process is expensive. Process takes time. Process demands records. Process can wear you down long before it proves you innocent. That is why this issue deserves calm attention. Not because a new regime has already swallowed your bank account whole, but because any system that expands reporting without extraordinary clarity creates anxiety for exactly the people least equipped to absorb more administrative friction. Now I want to do something that the internet rarely does. I want to separate what is settled from what is speculative. The settled part is this. The long-standing cash reporting rule exists. Large cash transactions can trigger reports. Structuring behavior can create trouble if you deliberately break transactions to avoid the threshold. That part is not new. That part has been around for decades. The unsettled part is broader. There were proposals to expand reporting beyond the old cash framework and into wider annual account activity. Those proposals triggered backlash. They did not become law in the broad form many people feared. And as of the source we are working from, proposals for broader reporting remain exactly that. Proposals, pressure, policy, conversation, possibility. Not final settled law that transformed the country overnight while everyone slept. That distinction matters. It matters because fear thrives on vagueness. When people do not know whether a thing is existing law, a dead proposal, or a future possibility, they tend to combine all three into one foggy threat. Fog is useful to politicians, activists, and content creators. It is not useful to citizens. Citizens need edges. Citizens need to know what is real, what is being discussed, and what has not happened. So let me say it plainly. The old threshold did not suddenly arrive yesterday. The broader expansion people worry about was debated, criticized, and not fully enacted in the broadest form described in the source. And if broader reporting returns in some new form, it would not materialize out of thin air with no legislative or regulatory pathway. That does not mean the concern is fake. It means the concern should be disciplined. Disciplined concern is intelligent. Undisciplined fear is profitable for everyone, except the person feeling it. The real question, then, is not whether you should panic, The real question is how a sensible person should behave when the rule is old, the policy debate is alive, and the future is not fully known. This is where I always come back to temperament. In markets, in business, in taxes, and in politics, the right answer is often the same. Do not act from drama, act from preparation. Preparation is quiet. Preparation does not post all night. Preparation does not forward chain messages to 12 relatives. Preparation does not turn lawful money into suspicious behavior because somebody on the internet told you the walls were closing in. Preparation does three simple things. It understands the rule. It organizes the records. It avoids foolish behavior created by fear. That last point deserves emphasis. When people grow anxious about thresholds, they often start improvising. Improvisation is dangerous. If you have legitimate funds and legitimate reasons for moving them, then the intelligent path is documentation and transparency, not cleverness. The amateur always thinks the risk is the rule. The professional knows the risk is the attempt to dance around the rule without understanding how the dance looks from the other side. That is true in investing. It is true in law, it is true in taxation, and it is true here. If you regularly handle cash for lawful reasons, keep good records. If you are in retirement and your financial life is ordinary but repetitive, understand what types of flows are cash and what types are not. If you help family members, document gifts and transfers appropriately. If you are managing required minimum distributions, pension deposits, estate, related receipts, or large withdrawals for a legitimate purpose, do not wait until confusion arrives before you organize the paper trail. By the time a nervous person starts reconstructing history, history has already become expensive. The time to organize the record is before anyone asks for it. What I am really describing is not tax strategy. It is self-defense through order. Order protects you from accusation. Order protects you from your own bad memory. Order protects you from turning a simple explanation into a messy one. I have watched enough business history to know that institutions tend to trust organized people more than disorganized ones, even when both are equally innocent. That is not always fair. It is still how the world works. Now I want to address a psychological mistake that traps millions of people. They assume that because they are honest, they are automatically safe. Honesty is essential. It is not sufficient. Honesty without records is a moral feeling. Honesty with records is a defensible position. Those are not the same thing. Retirees in particular sometimes come from a generation that trusted verbal clarity and good faith more than documentation. They believed that if a thing was obvious, it would remain obvious to everybody. But bureaucracies do not operate on obviousness. They operate on forms, patterns, categories, timing, and evidence. You may know exactly why money moved. The question is whether the file, the institution, or the reviewer can know it quickly without inventing doubts along the way. That is why calm preparation matters so much. And it also explains why privacy concerns resonate so deeply, because once more reporting enters the system, more data exists outside your control. Most of the time, perhaps nothing happens, but older Americans understand something younger people often overlook. When systems scale, mistakes scale too. If millions more accounts are swept into a reporting framework, somebody eventually has to process. Somebody has to decide what deserves attention and what does not. And when capacity is finite, false flags are not a philosophical problem. They are an operational certainty. That is not paranoia. That is arithmetic. A system fed vastly more data without perfectly matching human judgment will produce noise. And noise is hardest on the people least able to fight it. Which brings me to the biggest mistake ordinary people make when discussing this topic. They argue at the level of politics and ignore the level of personal architecture. They say, I support enforcement, or they say, I oppose surveillance. Fine, you can hold either view. But while the argument continues, your life still needs a system. That system should not depend on who wins the next speech cycle. It should depend on whether you can explain your own money clearly. That is the standard I would use. Could I sit down tomorrow, open a folder, and calmly explain the major flows in my life? Could I show where my retirement income comes from? Could I show why cash was deposited, if cash was deposited? Could I show why gifts were given? Could I show why withdrawals were made? Could I show that what appears irregular from far away is ordinary from up close? If the answer is yes, you are already ahead of most people. If the answer is no, then the real risk is not Washington, it is disorder. Disorder makes ordinary behavior look mysterious, and mystery is expensive. Now let us talk about the temptation to let this issue turn you into a worse decision. Maker, that happens all the time. People become so worried about being watched that they make themselves fragile in other ways. They avoid the banking system irrationally. They hold too much idle cash. They create awkward cash habits. They rely on hearsay instead of counsel. They start taking advice from people who understand outrage better than compliance. That is a terrible trade. You do not protect yourself from a reporting regime by making your financial life sloppier, less documented, more emotional, and more vulnerable to loss or theft. The answer is not to become dramatic. The answer is to become legible. Legible to yourself first, then legible to anybody who ever has to review the facts. When I look at issues like this, I always ask a different question from the one most people ask. Most people ask, what is the government doing? That matters. I ask, what kind of citizen behavior does? The answer here is very clear. It rewards citizens who are informed enough not to panic, organized enough not to stumble, and disciplined enough not to do anything foolish in the name of protecting themselves. That is the whole game. Let me put it another way. The retiree who gets hurt by confusion is not usually the one with the most complex life. It is often the one with the most casual habits. The one who says, I know where everything is. It is all in my head. The one who says, I will remember later. The one who says, I do not need to write that down. The one who says, this is just a family transfer. It is no big deal. The one who says, I will deal with taxes when the taxes come. That kind of looseness is survivable in a forgiving system. It is dangerous in a more data-intensive system. And if broader reporting ever does come back in some form, the premium on clean records and clear patterns will only rise. This is why the subject goes beyond one threshold or one proposal. It is really about a broader cultural shift. We are moving slowly and unevenly toward a world where more financial life becomes machine, readable before it is human. Understood, that is convenient for enforcement. It can be dangerous for nuance. Machines are good at noticing totals. They are not good at understanding lives. A widowed retiree helping a daughter through a divorce can look statistically strange. A senior receiving estate-related transfers while settling a family matter can look statistically unusual. A small business owner making lawful cash deposits from ordinary operations can look statistically patterned. The machine sees pattern, only context reveals innocence, and context belongs to the person who kept the records. So what should a sensible person do now? First, understand the difference between current law and future proposals. That alone eliminates half the fear. Second, if you deal in cash for legitimate reasons, keep precise records of source, timing, and purpose. Third, do not deliberately break lawful transactions into patterns designed to avoid reporting thresholds. That kind of cleverness is the expensive kind. Fourth, if you are retired and living on recurring income streams, Know your own annual flows well enough that you are never startled by your own numbers. Fifth, if you are uncertain about how a transaction should be handled, get advice before you move the money, not after. After fact advice is usually a reconstruction fee disguised as wisdom. Before the fact advice is strategy, that difference is worth a great deal. And finally, do not surrender your judgment to either side of the noise machine. Do not believe the people who tell you nothing ever changes. Systems do change. Nor the people who tell you catastrophe has already arrived in finalized form when it has not. The future is usually built one procedural step at a time. The way free people handle that reality is not by panicking and not by sleeping. It is by paying attention. I want to end where I began. The real issue here is not whether older Americans have something to hide. Most do not. The real issue is whether ordinary Americans understand the rules well enough to protect their peace, their privacy, and their position. Before confusion turns into cost. That is the test. You do not need to become a tax lawyer. You do not need to become a lobbyist. You do not need to spend your retirement years watching every whisper out of Washington, like it is a hurricane radar. But you do need enough understanding to know what the system already does, what it may try to do next, and how your own habits either protect you or expose you. A lot of people think financial safety means having enough money. That is only half true. The other half is having enough clarity to know how your money moves, enough clarity to know what triggers attention, enough clarity to separate rumor from law, enough clarity to keep records before they are needed, enough clarity to act like an owner of your financial life instead of a passenger in it. That is how you keep from being pushed around by every new headline. That is how you stay steady, while other people lurch from fear to denial and back again. And that is how you make sure that if the policy conversation gets louder in the years ahead, you are not one of the people scrambling to figure out what should have been obvious all along. The rule that matters most is not the one written in the statute book. It is the one successful people live by before trouble starts. Know the terrain. Keep your records clean. Do not act cute with thresholds. Do not confuse noise for fact. And never let fear make you financially disorganized. That is how you protect yourself while the doors are still open. That is how you keep your dignity in a system built to read patterns before it reads people. And that is how you make sure your retirement is governed by understanding, not by rumor.